So the big question on investors' minds right now is the bear market over? Are we ready for the bull? We'll talk about it in this video. So the question on everybody's mind right now is the bear market over? And how should you invest your money now? And just out of a curiosity here, I found this little slide on Twitter. It's pretty scary when you see a cloud formation looks exactly like a bear. I know they say everybody looks at a cloud, and 10 people look at a cloud and they all see different things, but that's a bear. And so hopefully that's not a sign from God talking about what's to come. But I think we do have some strong headwinds right now that are going to be hurting the market's return here for the foreseeable future. And I call these the four horsemen. And really, given any time, one of these four can be a bad thing for the market, but we have all four going on at the same time. First one is valuations. We're starting from the highest valuations ever by most metrics, even higher than the tech bubble of 2000. Second thing is interest rates are rising. Interest rates going up is never good for the market. We also have inflation rising, which over the long term, stocks should give you inflation protection, but over the shorter term, it's pretty painful for stocks because it takes a while for the companies to adjust their prices and make sure that their earnings are keeping up with the increased cost due to inflation. And then finally, the fourth horseman is an increasing dollar. And I'll show you that when the dollar gets stronger relative to other currencies, typically that's not good for the stock market. Now, the big thing is on Wall Street, a lot of analysts and a lot of pundits think that the Federal Reserve is going to step in and help the market once it really starts to struggle. I don't think that's going to happen this time. And in fact, pretty much all of the Federal Reserve governors are stating exactly the same. This one looks at 3 of the Federal Reserve governors basically saying, we are going to be hiking rates. We're going to be pulling the punch bowl away from the party. So who knows what they'll actually do, but at least right now, they're definitely going to be increasing interest rates, which pulls liquidity and pulls money out of the markets. Why are they going to do that? Why are they harming the markets? Well, the biggest reason is inflation. And we are in an election year. We got the midterm elections coming up here. And the party in power knows they're going to get slaughtered at the polls if people are getting hammered by inflation. So there is a lot of pressure on the Federal Reserve to stymie inflation at the expense of the stock market, the bond market, the housing market, everything like that. So they're going to hammer a little bit on the wealth effect to make sure that people can put food on the table and gas in their cars. The big thing you have to remember is that 40% of Americans don't have $1,000 in their bank account. So this inflation that we're experiencing right now is ravaging their budgets. So the Federal Reserve knows they have to do something, and I think they're going to continue to do it until the pain is really bad, until something breaks, probably in the bond market. So I don't think we have that Federal Reserve stepping in to be the hero of the day, at least not yet. Okay, so the first horseman I talked about was valuations. Valuations give you no indication of what's going to happen in the short term, but valuations are an excellent predictor for the mid and long-term returns you're going to get. It's like anything in life. If you paid $2 for a gallon of gas as opposed to $5 a gallon of gas, you're getting much more value at that $2 level for the same thing. Same with a stock. If you're going to pay for a stock a price to earnings at 10 as opposed to price to earnings of 20, you're going to get a much better return if you can buy it at 10. So I'm just going to show you some quick slides, which are a little bit dated, but it gives you a general overview to show you essentially that valuations are at levels that we've never seen before. This first one is used by quite a few people. It's called the Q ratio. Won't get into how it's all constructed and everything like that. Basically, I always tell people the way to think about this is if you were going to start a business versus buying a business, what makes a better choice at this point? When the markets are low valuations, it's better to buy an existing business. When you have high valuations, you're better off starting your own business. But you can basically see this is the peak of the year 2000, and we started this year substantially above that with the Q ratio. The second valuation metric is Warren Buffett's favorite. What this does is it compares the market capitalization of all publicly traded companies in the US divided by the GDP, which is the size of the economy. Now, why is this important? Well, you have to remember that we have a lot of publicly traded companies, but the vast majority of our GDP, of our economy, is made up by small and mid-sized businesses that are not publicly traded. So the bigger the publicly traded companies are relative to the size of the economy, the bigger the bubble is, the higher the valuation. So as I said, Warren Buffett says this is the best valuation metric that he uses, and you can see here's the dot-com peak, 1.95. So it was almost, the market cap of publicly traded companies was almost 2 times the size of the economy. Right now we're at 2.5 times. So even the financial crisis was only 1.4 times. So we are substantially overvalued relative to Warren Buffett's favorite metric. This one just looks at price to sales. So you take the sales of all the publicly traded companies and divide it by their prices. And you can again see that we're hitting peaks way above the dot-com and the financial crisis bubbles. Again, that tells us nothing about the short term, but it gives you some long-term metrics that shows you that the market dropping, we've got quite a way to go down based on valuations. The other thing that's really I've been harping on, if you've been watching any of my videos, is there's been small leadership in the market the past few years. You're talking 10% of companies in the S&P 500 make up almost 34% of the index. That's not healthy. That's not healthy when you have just a select few companies carrying the full load for the index. That typically reverses when you see that happen. Okay, the second horseman we talked about is a rising dollar. So as the dollar appreciates relative to other currencies, that's typically bad for the stock market. Not always. But here you can see the blue line is the value of the dollar. The red line is the S&P 500 index. So dollar's going up here, down goes the market. Dollar goes down, market goes up. Pretty much holds for the most part. Past couple years that hasn't been the case so much, but what we're seeing right now is the dollar is getting stronger and it's harming the stock market. The other thing is we've got interest rates going up as well. Interest rates hurt the market for a couple reasons. One, if you're a stock market investor and interest rates go up, you might decide to sell your stocks and go to bonds because you're now getting a higher yield on your bonds. The other reason it hurts the stock market is it just costs companies more to borrow, to build plants, to create products, all of that. So their costs go up, meaning their profits come down. This is a very busy chart. It goes all the way back to 1904. I'm not going to get into it too much. You can pause the video if you need to really look at it. But pretty much what you're going to see is anytime the blue's going up, the red's coming down. The red is a stock market index. Blue is bond yields. So typically, interest rates going up have a negative short-term effect on the stock market. This is basically the same chart, except it's the federal funds rate. So this is the interest rate that the Fed controls. Here again, anytime the Fed starts hiking, you start to see pressure in the stock market. Anytime they lower, the market tends to do pretty well. So what we have, as I said at the outset, the Fed is really feeling pressure to raise rates. They've already started doing it, and they've raised rates 0.75% thus far. But when you listen to what they're saying, they're talking about another 9 or 10 hikes easily this year. And of course, the fourth horseman that seems to hurt stocks is inflation. Again, if you want to look at it, this one looks at the S&P 500 price to earnings ratio. So it's not the actual index number, it's the price divided by earnings. And then of course you have the consumer price index as well. And again, pretty much a negative correlation. Not perfectly negative, but pretty close. You know, when one's going up, the other's going down for the most part. So typically usually you only see inflation and interest rates going up at the same time. Interest rates going up is in effect a sign that inflation is going up, and you usually don't see the dollar going up simultaneously. Typically when you have inflation, the dollar is going down. Makes sense, right? Your dollar buys less goods and services. But we have the dollar going up and inflation and interest rates. So any one of those three can really wreak havoc on the stock market, but we have all three of them going on at the same time. Throw all of that on top of high valuations, in fact, historically high valuations, and I think we have a mess that could be coming to the stock market. And to give you a little bit more idea on how inflation is going to affect the stock market, this is Meb Faber. He's a money manager I follow quite a bit. And he kind of gives you an idea of how the 10-year price to earnings ratio, so that's basically taking the current price to earnings and over the past 10 years and averaging it together. It gives you a more smoothed out ratio. But he says, typically, when inflation is between 0 and 4%, the average 10-year PE is about 20. So when inflation is greater than 4%, that drops to 13, and when it's greater than 7, you typically go down to a price to earnings of 10. Right now, as of when he did this tweet, we were at 40. So you can see, even if we're about twice the normal P/E valuation, even if we go to 4%, we drop all the way to 13. Now, outside of 2021 and 2022, the highest valuation ever awarded to the U.S. stock market above 5% inflation has been a 23. So even based on that, you're talking almost a 50% decline. So we're about 20% down thus far, give or take a percent or two. So there could be some pain ahead. Okay. So while there's also, the 4 horsemen right now that are causing pain, there's also 4 horsemen of protection. So these are asset classes that you want to look at to protect you if the market is going to continue its downward slide. These tend to do quite well when the market's dropping. The first one is cash. So cash is pretty obvious. If it's sitting in the bank, it's not losing value. You're going to at least keep the value you've got. You're not going to keep it on an inflation basis, but at least you're not going to lose the principal. The second thing is negatively correlated assets. So you want to go into asset classes that do move the opposite of what the stock market does. So that we're talking about the volatility index, and we're talking about actual put options. Now, put options, you have 2 kinds of options on the market. You have call options and put options. You buy a call option if you're bullish on the market. You buy a put option if you're bearish. So obviously, put options, people are buying that or thinking the market's going to go down, so they want to profit from a declining market. The third asset class is long-dated treasuries. Here again, if the stock market is dropping, you want to provide some safety to your portfolio. And despite what you think about treasuries, you at least know you're going to get paid back. The government at the worst could print money to give you your money back if you buy their treasuries, and you're going to get some interest rate on it. Right now, long-dated treasuries are about 3%. So if the stock market's going to drop, you might say, hey, I'm going to at least go to treasuries. I know I'm not going to lose money so much, and I get a little bit of an interest rate kicker. It makes sense. So historically, they've done well. Now this year thus far, treasuries haven't done well. They've been going down along with the stock market. But I have a feeling that that's probably going to change. And then the last asset class that tends to do much better during market downturns, stock market downturns, is gold. Gold is basically an insurance policy against chaos. So just to give you an idea, this one looks at the S&P 500 versus a volatility index that I use for clients. It's the ProShares VIX Midterm ETF, ticker symbols VIXM. And this goes back to 2017, but here again, you can pretty much see what I've been talking about, negative correlations. This was when COVID hit and the stock market dropped 35%. You can see what VIXM did. I mean, almost perfectly negatively correlated. But all the way through here, you can see spikes are negatively correlated. So it provides some protection if the market's going down. This is another holding that we use. It's the Cambria tail risk. So Meb Faber, who I quoted just a couple slides ago, he's actually the manager of this ETF, but it invests in put options. So it puts a certain percentage of the portfolio in put options, the rest goes into government bonds. You can see the negative correlation, especially with big market moves. So it's an asset class that by putting a little bit into it, you can protect yourself a little bit on the downside. I'm not saying that put all your money in these vehicles. I'm saying this is a place you can go to provide some protection to smooth out your ride a little bit. This one looks at the S&P 500 relative to the iShares 20-year plus Treasury. So you're talking Treasury bonds that are 20 years or greater in maturities. And for the most part, what you're going to see here is negatively correlated. Now, through 2022, for the most part, the start of it, both of them were going down. Don't see that often. Okay, this has been a pretty awkward year as far as that, but this is the Treasuries, and you can start to see it's popping up as the market's going down. I think we're starting to see it turn around to where Treasuries are going to provide protection against the market downturn. The reason I say that is interest rates have jumped up quite a bit. At the beginning or at the end of 2021, you could get a mortgage for under 3%. Now you're looking at anywhere from 5.25 to 5.5. That's a huge jump in such a short period, less than a year. So bonds actually have a natural ceiling to them. If they start to go up too far, too fast, it creates a deflationary environment because people stop borrowing. So it has a natural plug in there, so when it goes up too much, demand drops for credit. So as demand drops, the interest rate naturally comes back down until it finds the credit demand again. So I think that natural ceiling is going to be the protection that we're going to be looking for going forward. So now that TLT is yielding 3%, if the stock market starts to struggle more, I think money's going to run to grab that guaranteed 3%. So that's my prediction. It's not worth anything, but that's what I'm thinking right now. And the funny thing is, I've mentioned that the Fed is going to raise their interest rates, or at least they're stating that they're going to do that. So you would think if they're raising interest rates and they control the low end, the short-term bonds, why would all the other bonds not go up as well? And typically what you see before the Fed starts tightening, you do see rates go up. But then once the tightening begins, interest rates start to come down. Why would that be? Well, we go back to the negative correlation stocks. So as the Fed starts raising rates, they're pulling liquidity out of the markets. So the stock market struggles. When the stock market struggles, money leaves the stock market and goes to long-dated treasuries. So this graph shows you what the 10-year treasury yield did during periods of quantitative easing. So this is the opposite of pulling the punch bowl away. This is putting the punch bowl out. Quantitative easing is where they're printing money to provide liquidity to the markets. So during QEs, when they're actually easing conditions, the yield on the 10-year goes up. But then in periods where there is no quantitative easing or there's tightening, you can see the 10-year, the yield on the 10-year comes down. So despite the fact that in these periods they're tightening, they're pulling away liquidity, they're pulling a punch bowl away, you see the yields come down. And I suspect that that's what's going to happen again with long-dated treasuries.